Yeah, and that's why the trade press has called you the dean of high yield for, I don't know, probably 30 years now. So your track record on Wall Street and with institutional investors is well known. For folks who haven't ever heard of Marty or know of his track record, it's excellent. Um, and I want to get into the market dynamics of that. The thing that has always appealed to me about high yield bonds or distressed debt, whatever you're going to call it, is that you can have equity like returns with much less risk. And to put some numbers around this, the distressed debt team that I built at my previous publishing group, which was called Stansberry Research, and Marty, you and I knew each other there for many years. That team, the product is called Credit Opportunities, and it focuses on corporate bonds that are trading at a discount from par and offer higher yield. Over the last 5 years, they just published their report card, which is a study of her track record, the recommendations. Over the last 5 years, they had an 82% win rate and they had an average annualized return of 18%. And the last 5 years were a terrible period for the bond market in general. And these bonds were able to have a very high win rate because there is much less volatility in bonds than stocks. I'd say that a good stock picker is only right maybe 60% of the time. So getting that win rate above 80% is really incredible, especially when you're publishing on a monthly basis. And then an average annualized return of 18%, of course, that's beyond equity like. That's almost Buffett like in terms of return. So it's a really incredible track record. And these kinds of returns are possible in distressed debt because the market is very inefficient. And I just wanted to know from where that was always what attracted me to it. I wanted to know what's your opinion about those issues. Why is the market attractive in general to investors, and why are outsized returns possible? What's the underlying dynamic that makes these markets so attractive for investors?
Well, I think it's a couple of things. One is that the liquidity is not comparable to what you see on the New York Stock Exchange, you know, large cap issues. So when they bonds fall because of any sort of bad news or just a impression, fear about what may happen to the company, they can drop pretty severely. It's not as if you have a lot of standing orders, below the market ready to pick them up. That you hear the saying, anytime there's a bear market, don't try to catch a falling knife. That's what it's like. The dealers like to say, we always have a market. You may not like our market, but we're always there. Except that when the market starts to go down, they stop answering the telephone. So those bonds really drop like a rock. And often it's that they've been downgraded